Happy Tuesday out there, Team 42. It's your skipper here, Darius Dale, to present our macro minute for Tuesday, December 12th, 2023. As always, we'll start with our executive summary from today's leadoff morning note. As if you would like the analysis supporting these conclusions, as well as what to do about them in your portfolio, you need to be a client of 42 Macro. So number one, the November CBI release was quite mixed and supported both the soft and no landing scenarios. Number two, the acceleration to a well above trend 3-month annualized pace of supercore CPI, which is 5.1%, is alarming considering market pricing of aggressive rate cuts over the next 12 months. 1-year U.S. dollar overnight index swaps are pricing in 133 basis points to be exact, and Fed funds futures currently see rate cuts starting in May of next year. Pushing back against this hawkish undertone of this underlying inflation metric is the fact that supercore CPI has materially diverged from the Fed's preferred inflation gauge, the PCE deflator, in recent months. The last few 3-month annualized rates of core CPI read 4.7%, 4.8%, and 5.1%. Conversely, the last few 3-month annualized rates of supercore PCE read 2.8%, 3.7%, and 2.6%. The November PCE data reported on Friday the 22nd, and will go a long way towards settling this uncomfortable divergence, and will obviously have market implications. Number three, the November NFIB Small Business Optimism Survey was quite mixed as well, and supported each of the soft, no, and hard landing scenarios. So, in conclusion, obviously we're not getting definitive data pointing to either scenario. So that's unlikely that we see an exit from the current top-down market regime, which is Goldilocks. You need a reason to exit the Goldilocks regime, in our opinion. In terms of transitioning to our 42 macro dashboard here, we got one key macro market indicator bought or oversold this morning, and that's gold. Gold is currently oversold here, so a great spot to be adding bullion if you believe in the medium-term outlook, which is consistent with the expectations of a soft landing. And then lastly, transitioning to our 42 macro aware community. Got a great question on the divergence between our top-down and bottom-up regime signaling. So the question reads, hi Darius, I like seeing the grid forecasted models for different countries because it gives me some confidence in what things might look like in the following year. I understand that you prefer to focus on the top down, and I really like your approach. In your opinion, what is the best way for us to use the grid model in the Excel sheet? We send out, so all of our models, not only the output of the models, but also the back tests associated with each of those models. We publish those results and the output every week in our round the horn presentation and every month in our macro scattering report. So we don't put anything in front of clients unless it's carefully back tested, and we don't put anything in front of clients unless they have access to those back tests. So we definitely do things a little bit different here at 42 Macro. We want you to have faith in what we're doing. So going back to the subscriber question, says I'm putting myself in their shoes. I manage money in long-only portfolios where I cannot switch things as quickly as weekly or monthly, and it's nice to see a given country could potentially have some Goldilocks or reflation in the months coming. The meat of the question is how to think about incorporating our bottom-up macro regime forecasts into the subscribers investment process. Generally speaking, we 42 Macro, our investment recommendations, portfolio construction guidance, asset allocation guidance is generally born out of our top-down signaling tools, our quantitative risk management tools, namely our global macro risk matrix, which identifies the top-down market regime, what the markets are pricing in, as well as our weather model, which gives us an indication on sort of how asset markets are likely to behave from a price and volatility perspective on a rolling 3-month forward basis across asset classes. Those two tools are really kind of the linchpin of how we think about helping investors manage risk in their portfolio. We have other tools that we kind of help us think about medium-term qualitative sort of outcomes in the economy, i.e. soft landing, no landing, hard landing. That be part of the qualitative that's qualitative research, different and separate from our quantitative research. And so in terms of how to actually kind of marry those two things together, in my opinion, I think it's a better process, and you will likely have better results. We certainly have had better results and helped our clients have better results by primarily orienting your portfolio around the evolution of the quantitative risk management signals. Now, some of those signals may change a few times a year. Global macro risk matrix, you're probably going to be in 2 to 3 regimes per year. So that's it's obviously not a ton of trading, but for someone who wants to trade even less than that, it's probably better to kind of focus on more medium to longer term qualitative research signals, i.e. where is the economy headed, where's inflation headed, where's growth headed, how's policy going to react to that. So to me, it's there's no real answer to the question, but the answer to the question really depends on who are you as an investor. Do you want medium level turnover in your portfolio, which is what you would do, which is what you would experience if you followed our quantitative risk management signals, or do you want a low level of turnover in your portfolio, which is what you would experience if you're following our qualitative research views? And then do you want a high level of turnover in your portfolio, which most institutional investors have because their job is to make money every single day? If you want a high level of turnover in your portfolio, then you obviously need to be hyper focused on our quantitative risk management signals, namely the shorter term signals like our crowding model, probable range model, VAM signal, et cetera, et cetera. So, we produce research for every type of investor in the world. We have clients all across the asset management space who do different things, at different asset managers do different things, at different corporate pension funds and corporate treasurers and insurance funds. We have all kinds of clients who manage different types of assets and have different investment objectives. So it's our job to produce research that can service the needs of all of them. And it's your job as someone who's a client of 42 Macro to figure out what it is that you need from us and then only focus on that, as opposed to trying to piece together everything that we put out, because it may not be relevant for how you choose to invest. So hopefully that's helpful. We'll wrap it up there. We'll catch you back here tomorrow. This is Darius Dale reporting our macro minute for Tuesday, December 12th, 2023.